Okay, we're going to look at the last part of problem 32, the sort of the B and C part. But before we go on, I just want to make sure that we all understand that this is a credit accrual entry on that contingent performance. Just like in the problem 23, it remains a contingency liability, which makes up the purchase price of this, until we see what happens in the future, if the contingency gets paid in full or not, and it'll be adjusted if it doesn't get paid in full, exactly the way we did in the other problem. If there's any question on that, let me know. Okay, so for the next part is we're going to now see what it looks like to do a consolidated balance sheet only, because it's only balance sheet for the date of acquisition. That's not to be forgotten. Why they give you the income and expense accounts, I'm not sure, but it is purely irrelevant, because this problem, like many things in real life, is the bank is only asked for, I'm saying bank because that's how it works in real life, the bank is only asked for consolidated balance sheet as of date of acquisition. That's how you look at this problem if you want to try to relate it to the real world. And that happens. You say, okay, you purchase this, show us what the balance sheet looks like at the date of purchase. Sometimes it's pro forma, meaning you have a contract you're going to acquire, and the bank will say, give us a balance sheet, project it as it'll look at date of acquisition. Since it's only the date of acquisition, there are no income and expense accounts. It's only one day. It's a picture of balance sheet accounts only, and so all income and expense accounts are really irrelevant. Okay, let's take this off, and we'll move forward to the next parts of this problem here. And I guess what I'd like to do is show you how these sheets work before getting into the nitty-gritty of the numbers. The way these worksheets, this is your first time seeing a worksheet like this, I think, at least with me by your side. The way these worksheets operate is we get this parent company, this is the parent company here, we get their information, and since we're only concerned about balance sheet, let's circle that or indicate that. And then the next column is the surviving subsidiary entity. And remember, this is it survives as a legal entity unto itself, and that's why we have a column for it with its numbers, because it needs to keep its own set of books. So this reflects the set of books of Seguros at book value, not at fair market value. We know what the fair market value is because it's part of the purchase price. The problem gives it to us. Pacifica did its own valuation, came up with the values of each one of these items, but these are being reflected at their book value at this time, right in this column here, because that's what's on the books of the subsidiary. The books of the subsidiary do not change. Where the change will come is in the presentation of the actual balance sheet itself, where we will adjust the book values to the fair market values that we found upon purchase price. The problem tells us that, shows us, if you look back at the problem, it shows you Seguros' book values and fair values, and where we want to go is we want to go from here, I'm sorry, let's undo that. We want to go from here, the book values, to the fair values, and that's what these A's are going to be about, moving the assets and liabilities to the fair value as told to us by the problem. I guess we saw a little bit of this in class somewhat, so this is not 100% your first time, and you tried it on your own, I hope, and you can use Excel spreadsheets, that's fine. I encourage you to do that. What we're going to be doing is we're going to be adding across. We're going to be adding this column, so we'll just say add A plus B, the book values, and then in order to get to the end result of what the consolidated balance sheet should look like, we're going to have to make what they call consolidation entries here, both debits or credits, to know which way to add across. So if we're taking cash, for example, 86 plus 85, if there was a debit or credit here, a debit would add more, a credit would take away cash. There's nothing there because cash is cash, so it just adds across for the 171. You're done with cash. That's how this is going to work. So in my approach in class, what I said today is, like, for example, let's take receivables and inventory. Receivables and inventory, they tell us in the problem that although they are on the books of Seguros at book value of 190, their real value should only be 180. So the goal is to move, and don't look at the consolidation entry yet, just bear with me. The goal is to go from, I've got to erase some things here, so hold on a second. Let's erase a little bit of the war effort. Our goal is to go from the 190, which is the book value, to, when things get combined, to a value that's only going to add in the fair value, and the fair value is 180. So if the fair value is 180 for this line item, and over here it's 750, the total combined at fair value should be 750 plus 180, and that's 930. And to get to 930,000 that is, if we take this 750 and this 190 and add it across, it's going to be too much. It's going to be 940. So how are we going to move that in our worksheet so it's the right number? Well, you're not going to debit because that'll add to it, but you will credit, and that's what this is about. That's this credit here. So that when you do the math, it's 750 plus 190 minus, because it's in the credit column, 10, and it brings you to, you guessed it, like magic, 930. Let's take another example so you can see how these worksheets are operating. And you can see what's actually happening is when you do this sort of brute force or logic, or almost like a chess game of what numbers you need in these two columns here to make it all work out, you wind up getting the entries that the problem is asking for. So again, I don't want to take away from doing it the textbook way, but I also want you to see what is it the textbook way is actually doing. That might make it easier if you go back and read the textbook way again after having gone through this exercise of watching this crazy video. Okay, so moving along, the fair value of plant, property, and equipment is not 450, as it says here, but it's 600. So now you can see, without having to do the exercise the long way, you can see that it's undervalued. If we just add it across, it's undervalued by 150. So it must be that in order to bring the value up, it's going to be a debit, and there you are, debit 150. That is when you now add what the parent has and what the subsidiary has, what the son, if you want to call it the son, but it is a subsidiary. When you add those two together and then add this also, the result will be you will get a number, which is the 2 million, which is a reflection of the book value of plant, property, and equipment of the parent, and the fair value at date of acquisition of the subsidiary. Let me say that again, because that's what we're doing on all these lines, but it's good to say it here at this example, so it applies to all lines, but it's really, really important to get the grasp of what we've done. When we make this debit, and we make the debit here because we need to add to this amount over here, we need to add to it 150, because the fair value is really 600, not 450. Fair value is really 600. When we do that, what we're going to wind up doing is that way the columns will work like this. There's the parent column, the subsidiary column, and I'll call it the adjustment column, and then the final. So the result will be that you take the parent's book value, which is that what we have. We take the subsidiary's book value, which is given to us, and then these adjustments bring the subsidiary numbers to their fair value at date of acquisition. Because that's the date we know now what the fair value is. It was purchased that date. We now know what the fair value should be. So we compare it to the book value here, and we say, in order to go from point A to point B, we're going to need something in here to bring those to that fair value, so that when we get here, it's a combination of parent book value amount plus subsidiaries fair value at date of acquisition equals acquisition date balance sheet. Voila. And that's what we're doing. Each one of these columns is taking care of doing that. So let's stare at this a while. Let's see if I can get it to a point where you can see it all. Almost. Yeah, there you go. Hopefully you have a large enough screen that you can zero in on anything you need to. If you look at each line and compare it to what the problem tells you, this final column here will now be what I just described. It'll be a combination of the book value of the parent and the fair value of the subsidiary at the date of acquisition, and that gives you acquisition date balance sheet. In fact, the correct title for this should be consolidated acquisition date balance sheet. That would be the best title for it. And the financial statement itself would be just a balance sheet. It wouldn't show any of these lines here of income and expense, because it would just be a balance sheet. You're allowed to present a financial statement that is just a balance sheet. All right, that's almost the whole picture of what we're doing. That is certainly the picture where we can say this is all true of assets and liabilities. It's all true of the assets and liabilities. But there, as you've learned for this acquisition date balance sheet, there's the A and then there's the S, as the textbook call it. So let's take a look at the S, again, from a theory standpoint. Let's do the following. Let's, again, sort of clear the playing board. You get the ability to watch this over again. Not sure that's a blessing or a curse. You decide, but don't tell me. Okay. So what we're doing now for the rest of the combination is we're now going to be concentrating, since we already did the assets and the liabilities. We did that. That's what we've done so far. That's the A part of the textbook approach. Now we want to concentrate on the S, which is looking at the equity accounts, the equity accounts. We talked about it in class, but one more time, and maybe with a different slate approach to it. The readers of this consolidated financial statement are the owners of P. Those are the readers, the shareholders of P, the parent. P owns the subsidiary, and in turn, the shareholders of P own the subsidiary. What do I mean? Let's take a look at it like this. Here's the subsidiary. It's owned by the parent, and the parent is owned by shareholders here. Let's see who they are. Well, there's Mr. Thin Man, or Stick Man, and there's their best friend, who's, oddly enough, built this very similar to themselves. And there's a whole bunch of these odd-looking alien shareholders of the parent. But indirectly, well, actually you should say directly owning subsidiary are the shareholders of P, as you can see, because they own the parent, which in turn owns the subsidiary. Think of it as your grandparents. So your grandparents you're the grandchildren. Do they own you? Well, they don't own you, but are they related to you? Yes, they're related to you through the parent, and they're you. This is you. There's the parent, and then there's the grandparents. So the shareholders are like the grandparents. They're direct descendants. So the way this works with shareholders is these shareholders own the subsidiary, but they own it through their ownership of P. So, having said that, I don't know where that gets us, but let's see what it gets us when I go back here. What it gets us when we go back here is that since the parent owns the subsidiary, the only equity section that is of interest to the shareholders of P is the equity of P. The equity of P is down here: common stock, paid in capital, retained earnings. That's the equity. Should draw a line there because that's the total. So this represents, let's go down here. This represents the holdings of these guys, the aliens that own the parent. The stock of S is owned by here. So to show the common stock of S to these guys doesn't make any sense to them, because they only own P. They directly own P, they indirectly own S through P. Bottom line, I hope you can follow the reasoning or check the textbook if you want to maybe read it to see it, is that the bottom line is that the equity accounts of the subsidiary have to go to zero. That's the only place they can go. The equity accounts of the subsidiary, that's this column here, go to zero because they exist in terms of the subsidiary as its own unit, but in a consolidated total, they don't exist. The consolidated owners are just the shareholders of P. So this becomes an easy entry when we get to these two adjustment columns of debit and credit. It becomes an easy entry because whatever these are here, they have to go to zero. That's the end result. So you can see how easy it is. Debits across the board because these are all credits. So debits across the board for the exact same amount. So that when we add over, when we take the parent's equity accounts here, do a different color, let's get an even different color than that. When we do the parent's equity accounts here, to show it as a consolidated statement, that's the only accounts that show up over here. We do not add in the subsidiary. And that's your S entry. All right, that's how this problem gets solved. Send me questions that you might have, and we'll go over that specifically. I'll make a specific video for any questions.